America owes more money than any empire in history. The debt is now so large, it can never realistically be repaid. So what happens next? Most people think taxes will fix it, spending cuts will fix it, growth will fix it. But what if the real answer is something much darker? By the end of this video, you'll understand why the dollar may have to lose value, and why gold, silver, and hard assets could become the winners. To understand what's coming, you first have to understand how the system really works. It begins with a simple fact. The government spends more money than it collects in taxes. To fill this gap, the Treasury issues bonds. Think of them as IOUs from the US government. These bonds are bought by everyone: banks, pension funds, foreign countries, and even individuals. But here's the secret. This system doesn't survive by paying debt off. It survives by refinancing forever, constantly issuing new debt to pay off old debt, while the interest compounds relentlessly. This perpetual refinancing has led us here, $36 trillion, a number so large it changes everything. At this scale, the interest expense becomes a monster. It's now one of the largest items in the federal budget, rivaling defense spending. Think about that. We will soon spend more servicing past debt than on protecting the country. This creates a terrifying feedback loop. More debt is needed just to service the old debt. The government is forced to auction off more and more bonds at higher and higher rates. And then came the trap nobody wanted to talk about. The Federal Reserve is now trapped. If rates stay high to fight inflation, the interest on the debt becomes unaffordable, risking a severe recession. This path leads to job losses, bankruptcies, and a brutal economic downturn. But if rates fall to make the debt manageable, it risks reigniting inflation and causing the dollar's value to collapse. This path leads to a currency crisis, where your savings lose their purchasing power. They are not choosing prosperity, they are choosing which crisis arrives first. In this environment, traditional analysis fails. There is a force more powerful than company earnings or economic growth. That force is liquidity. Markets move on liquidity. When central banks expand the money supply through programs like quantitative easing, that money has to go somewhere. It flows into every asset class, lifting all boats. When money gets easier, everything starts floating. This liquidity is injected through many channels: QE, the repo markets, and changes in bank reserve requirements. Conversely, when liquidity is withdrawn, the tide goes out, and everything falls together. This is the great deception. The market becomes a gauge of monetary policy, not economic health. So, as the system becomes more dependent on creating liquidity to manage unpayable debts, where does smart money turn? It turns to hard assets. Assets that exist outside the paper currency system. This is why gold and silver matter again. Central banks around the world, especially in the East, are quietly trading their paper dollar reserves for physical gold at a record pace. Silver, meanwhile, has a dual appeal: surging industrial demand for green technologies, plus its long history as the people's money. When trust in paper weakens, metal starts speaking. The endgame of this crisis isn't felt in the halls of government, but at the kitchen table. The most direct impact is the erosion of your purchasing power. Your savings lose value. The cost of a full grocery cart climbs relentlessly. Housing affordability is crushed. The cost of rent, gas, and insurance consumes an ever larger portion of your income. You may earn more dollars, while being able to buy less life. The traditional advice to work hard and save money begins to fail. You're forced to take on more risk just to tread water. It's the quiet desperation of a generation that plays by the rules but finds the game is rigged against them. In the face of this, panic is not a strategy. Smart money does not panic, it prepares. The first step is to get your own financial house in order. Lower your debt, especially high-interest consumer debt. It's a guaranteed way to stop leaking wealth. Second, build emergency cash reserves. Cash provides options. It is the dry powder that allows you to seize opportunities when others are forced to sell. Third, diversify intelligently. This means owning productive assets like businesses, tangible assets like real estate, and, crucially, hard assets. A prudent allocation to physical gold and silver acts as financial insurance against the very currency devaluation the system is now engineered to produce. Finally, cultivate a long-term perspective. Study monetary history. Understand the cycles. This knowledge is the antidote to fear. The biggest wealth transfers rarely happen with warning sirens. They happen slowly. While most people stay distracted, the question is not whether the system changes, the question is whether you saw it early enough.